What's up everybody, Nate here, and unfortunately the stock market has done nothing but tank and drop so far in 2022, and unfortunately it looks like that may continue into next year. Many investors and Americans right now are worried about a potential recession and job loss around the corner, and many are fearful that the Federal Reserve is going to cause it. Now, over the past few months the stock market has gone significantly down, and that is really strange considering we've gotten reports from the CPI or inflation reports that inflation is going down. So that is a good sign that Americans have a little bit more money to spend, and it means that costs and other things can go down for businesses. So that's pretty positive. The Federal Reserve, just as early as December, actually showed that it might slow down its interest rate hikes in the future as well, which means we're not going to have as much pressure and as much restrictive conditions on our economy going into 2023. And we've also had some better than expected earnings reports. There are a ton of companies that we thought would get affected by these big supply chain issues, a lot of economic lockdowns, and the social unrest all throughout the world, not to mention inflation, but that hasn't really been a factor as of yet. So what exactly is going on here? Do investors not like these positive signs? Well, the reality is investors are super worried about the Federal Reserve right now because investors believe that the economic conditions that we're currently facing are enough to put us into a recession, and the Fed has basically told us that they are going to continue upping their interest rates in the future. These interest rates might be a little bit smaller. So for instance, over the summer we had 4 consecutive 75 basis point hikes, but the Fed in December actually only raised its interest rate by 50 basis points. So that is a smaller rate hike, but they're signaling that those type of hikes could continue well throughout 2023. And they're going to stay there for the extended future, which means that interest rates are going to remain very, very high, and that is going to put a damper on our entire economy, from consumer spending to business investment. Basically, the Federal Reserve wants to bring down inflation to its 2% mark, but right now inflation is well over 7%, so they have a very, very long way to go, and many experts and Federal Reserve governors themselves have said that interest rates are going to have to go up to well over 5% in order for them to have a significant impact on our economy and inflation. Right now, interest rates are just over 4%, which means we have a long way to go in order to bring down inflation, and we don't know how fast inflation is going to come down once interest rates have been elevated to that level. I mean, think of it this way. The Federal Reserve has gone from 0% interest rates back in January 2022 to now 4.25% interest rates by December 2022. So they've raised their interest rates very quickly and very aggressively from 0 to well over 4%. But inflation really hasn't gone down yet. It's slowly gone down, which means we have an inflation problem that might be deeply entrenched in our economy. So the Federal Reserve has to kind of figure out, well, what are we going to do to bring this down? Well, and that answer depends on a ton of different factors, because right now the biggest thing that is causing a lot of our inflation problems is something that we can't really revert, because it has to do with all of the money printing that our government and the Federal Reserve has done over the last couple of years. The Federal Reserve has stimulated the stock market with around $9 trillion in its quantitative easing program. That offered a lot of liquidity for the stock market because the Fed was literally buying corporate bonds. So that helped a lot of businesses to get out of the slump that they were in back in 2020. And that also meant that a lot of businesses were going to start hiring a lot of people and increasing their production and putting more products on the shelves. So that way Americans, with all of this extra money that they had from stimulus payments and all of these other government programs, well, now they were able to go out and buy things. They were basically just making whatever they could to meet demand. And that was all fine, except for the fact that the Federal Reserve has now printed a ton of money. By definition, inflation just means that the value of your dollars is going down. So that means that Americans are not going to be able to have the same buying power that they did before. Everything that they used to buy costs a lot more now, but they don't really have that much more money, so they are forced to buy less, and that hurts businesses and it hurts everything in our economy. But businesses can't really lower prices because they're producing a lot more. They still have their own costs to take on. If they reduce prices, then that's just going to hurt businesses even more. So one of the things that can happen is businesses give out raises. Now everybody makes more, so they're able to buy more, but this can kind of get out of control if people then start to buy even more on top of that. Then businesses have to give them another a raise because they're making more. And eventually the raises and the costs for everything are just going to continue to go up and up and up forever. This is called the wage price spiral, and it can get out of control if you don't have price stability. Well, so that's what the Federal Reserve is looking at, and that's what the Federal Reserve wants to prevent in the future, but they're going to have to raise their interest rates in order to do that. The Federal Reserve basically controls our economy with demand, so by raising their interest rates, that lowers demand because now it's harder for businesses and investors and Americans to go out and get loans. Loans are how people buy major things like a car or a house. With interest rates going way up, people are no longer able to get that because they can't qualify for a loan. The same thing happens for investors. Now, investors want to make money off of their investments. They have a return on investment that they want to meet. If interest rates get higher than 5% and 6%, now it's going to be way harder for them to actually get a return on their money. So they're just going to avoid that. That means the stock market goes down. And when the stock market goes down, that means the businesses that trade on the New York Stock Exchange aren't getting that liquidity that they had before. They have all of these extra costs. They have all of these people that they need to pay. So they have to figure out a way to cut those in order to save money. Not only that, but with Americans spending less, that means businesses are now not getting that investor liquidity and they're not getting those consumer dollars either. Obviously, the Federal Reserve can then just lower its interest rates and you'll have a ton of business expansion all at once. That's exactly what we've seen over the last couple of years, but that doesn't really help your inflation problem all at once. And that is what the Federal Reserve is focused on right now. They want to lower inflation before it becomes too big of an issue. But there's one more key aspect that the Federal Reserve controls, and that has to do with expectations. The Federal Reserve controls what expectations are going to be for the market. So when people hear that the Federal Reserve is going to get aggressive on its interest rates, well, that signals to them that there's going to be a lot less money floating around. And when there's a lot less money, there's a lot less business expansion, there's typically more unemployment, and there's a lot less spending. So investors know that they're not going to get as big of a return on their money in the stock market. So they're moving their money around. And it's not just the United States. Central banks all throughout the world are doing the exact same thing. We're talking about the UK, we're talking about Canada, we're talking about Japan. All of these countries are some of the biggest economies in the world, and there is a lot of money there, and they're all raising their interest rates, meaning business spending right now for a lot of investors just is not the way to go. They're going to other things, like they're going to real estate or they're going to commodities. We have had inflation come down in our economy, and that is a good sign, but you've got to remember investors in the stock market invest in companies based on the future outlook of our economy. Most are not in it for today. I mean, there are some short traders, but those people are going to continue to make money and lose money in the exact same way. They play the stock market as a game, but most investors who are in it for the long term are seeing all of these changes, and they're realizing that what the Federal Reserve is doing right now may cause a recession in the future, one that we can't just easily get out of. That's because investors are looking at business expansion like all of these tech companies. Like the NASDAQ is mostly just tech companies, and most of them have all fallen, lost a ton of value, and some have even filed for bankruptcy because of the Federal Reserve and because of a lack of consumer spending. And the Fed is saying that they're going to raise interest rates even more. So what do you think that means for all of those tech companies? It means they're going to suffer even further into 2023, and that could lead to even more unemployment and even more layoffs. But with the Federal Reserve saying that they are going to keep their interest rates high until inflation comes way down, well, that could be months and even years of really high interest rates, and businesses not really able to hire people on top of that, which means a prolonged period of no spending. Because if the Federal Reserve raises its interest rates too fast and too aggressively, then that means too many jobs are lost. It means too many businesses lose money all at once, and all of that consumer spending and business investment is what drives our economy, which could send us again into a recession. So the bottom line here is the Fed basically has to control those expectations with all of their announcements, and they have to let people know right now that they are serious about bringing down inflation. Because if they don't, then that is also a really bad sign for businesses as well. So the Fed at the end of the day is in between a rock and a hard place, and there really isn't a clear answer for them to kind of fix our economy. Most of your banking CEOs and your business owners are predicting a recession of some type in 2023 because the Fed really has no other way other than to raise interest rates in order to bring down inflation, and there is no guarantee that even that is going to work. We have other issues like supply chain problems and economic lockdowns that are causing and contributing to inflation right now, and the Fed doesn't have control over that. These are all things that investors are looking at, and the bottom line here is that they want to get out before things start to get really ugly next year. Now, I want to make something very clear here. There is no guarantee that any of that is going to happen. Our supply chains could improve. We could have zero economic lockdowns in 2023. The Fed may realize that their interest rates are high enough to where inflation is going to start coming down naturally. So that means that they might be able to start lowering them in the future. And that is the other thing that you have to keep in mind here. The Federal Reserve flip-flops a lot. They say one thing and then they do another. That is because the data is constantly changing and they have to keep people on their toes because they can't just come out and say exactly what they are going to do, because that might scare people or it might excite people too much, causing a boom or a massive bust in our economy. So they have to be very careful with what they say and what they do at all times. That is why you have to look at the data, you have to look at the news, and you have to be financially educated with your own money in order to make the right decisions that matter to you. The stock market is going to do its own thing. The Federal Reserve is going to do its own thing. And what you've got to remember is those two parties have very, very different goals and very different reasons for why they do things. But at the end of the day, you can't just rely on one or the other. You have to do your own due diligence and you have to be the master of your own finances. Otherwise, you might become broke trying to figure it out in 2023. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it from me, everybody. Be kind out there, and I'll see you all in the next one.